If you're following the metals market, you need to pay attention right now. I'm serious. Because as you're watching this, silver is hovering around that $80 to $82 zone after what can only be described as a historic collapse. 34% gone in days. And here's the part most headlines aren't telling you. The real trigger isn't panic, it's policy. Stay with me because I'm going to show you exactly what just changed, why it matters, and more importantly, how you can recognize this setup before the next move blindsides everyone else. Before I explain what caused this, let me teach you something most investors learn the hard way. Markets don't crash because of bad news. They crash because expectations shift faster than positioning can adjust. Think of the market like a crowded theater. Everyone can sit comfortably, until someone smells smoke. Then suddenly the exits matter more than the show. That's what you just witnessed in silver, not a fire, the fear of one. Here's what you need to know about metals like silver. They're extremely sensitive to the future path of interest rates and monetary discipline, not today's rates. The future ones traders think are coming. When markets believe money will stay easy, silver tends to rally because liquidity floods speculative assets. But the moment traders sense tighter policy ahead, that tide goes out fast. And when it does, you discover who was swimming with leverage. So what does that tell us? It tells us that price action in metals is often a leading indicator of policy expectations, not a lagging reaction to reality. And that gap between expectation and reality, that's where fortunes get made and lost. If this is making sense so far, drop a comment and let me know where you're watching from. I want to know if you're holding positions right now or sitting in cash. Now here's what's actually happening. The sequence matters a lot. First, the nomination of Kevin Warsh as Fed chair hit the tape. Markets immediately interpreted that as a pivot toward a more disciplined central bank. Less tolerance for inflation, less eagerness to cut, more credibility around tightening if needed. Now you might be thinking that's just political noise, but here's the thing. The bond market doesn't trade political noise, it trades credible threats to the status quo. And Warsh represents exactly that, a shift from accommodative policy assumptions to restrictive policy risk. Second, geopolitical tension cooled. Renewed US and Iran talks reduced the urgency for safe haven exposure. Think about what that means. Silver had been catching a bid partly from fear-driven demand, partly from concerns about supply disruption, partly from the classic flight to tangible assets when uncertainty spikes. But when diplomacy appears to be working, that fear premium evaporates. Fast. So you suddenly had two pillars weakening at once. Monetary support and fear-driven demand. Both props got kicked out from under the price at the same time. That's not a coincidence. That's a confluence. But here's what's wild about this. The crash wasn't just emotional selling, it was mechanical. Silver had become overcrowded after that massive rally. Hedge funds were stacked long. Retail momentum was chasing highs. Futures positioning was stretched to levels we hadn't seen in years. So when volatility spiked, exchanges raised margin requirements. And when margins rise, leveraged traders don't debate. They don't wait for confirmation, they liquidate immediately. This is where the cascade begins. Prices drop, margin calls hit, more positions unwind, liquidity thins, spreads widen, and the move feeds itself. It's less like a gentle correction and more like pulling a structural beam from a building. Everything that was supported by leverage suddenly has to find new footing. And in that process, price overshoots, always. Let me show you how this plays out step by step. A trader buys silver futures at $110. They're using 5-to-1 leverage because they believe the trend is strong. Silver drops to 105. Their broker increases margin requirements by 20%. Now they need to either post more cash or reduce exposure. They don't have more cash, so they sell. Their sell order hits a thin market. Price drops to 100. Now another wave of margin calls triggers. More forced selling. Price hits 95, then 90, then 85. You see how this works? It's not about fundamental value at that point. It's about survival. Now let me show you what most people are missing. The fact that silver is still holding near $80 after that kind of liquidation tells you something important. Panic selling may already be largely flushed out. The weak hands, the over-leveraged positions, the momentum chasers, they're gone. What's left are longer-term holders and value buyers starting to step in. The question now isn't why did it crash? The real question is, does it stabilize here and build a base? Or does it enter a deeper consolidation while markets reprice the entire policy regime? But here's the part that should make you pay attention. This exact pattern has played out before. And when you know the pattern, you can position ahead of the crowd instead of reacting with them. Zoom out to 2013, the so-called taper tantrum. Metals didn't fall because the Fed actually tightened immediately. They fell because traders suddenly believed the era of endless stimulus was ending. Ben Bernanke just mentioned the possibility of tapering bond purchases. Not even doing it, just talking about it. And gold dropped over 20% in months. Silver got crushed even harder. What happened next? A multi-year consolidation before the next major move. Same pattern we might be seeing today. Look at 2008's aftermath. Once forced deleveraging began, commodities overshot to the downside before eventually rebuilding. Oil went from $140 to $35. Copper got cut in half. Silver collapsed from $20 to under $9. But here's what's critical. The fundamental case for hard assets didn't disappear. It just took time for positioning to reset and for new buyers to emerge at rational levels. And even in 2020, after the liquidity shock, silver initially collapsed from $18 down to $12 before staging one of the strongest rebounds in decades. Within months, it was back above $28. Why? Because once the forced selling exhausted itself, the fundamental drivers reasserted themselves. Every time you see this pattern, the sequence is the same. Positioning breaks first, narratives adjust second, fundamentals reassert last. The larger story is rarely the crash itself. It's whether the macro backdrop truly changed or whether you just witnessed a technical reset within an ongoing bull trend. Now, before we go further, let me be skeptical for a moment because I want you to hear independent thinking, not just hype. Could this interpretation be wrong? Absolutely. Markets sometimes overreact to political appointments. We've seen Fed chair nominations that seemed hawkish turn out to be far more accommodative once they're actually in the role. Expectations can reverse quickly if economic data weakens. And yes, you're going to hear claims about manipulation. You always do after violent moves. Someone always thinks it's rigged. Here's the thing. It doesn't actually matter whether there's some shadowy entity suppressing prices. Debating conspiracies won't protect your capital. Understanding mechanics will. Focus on what you can control. Your sizing, your leverage, your time horizon, your entry and exit discipline. Those are the variables that determine whether you survive volatility or get wiped out by it. There are probably 3 types of people watching this right now. First, you might be the investor who chased the rally and is staring at red positions. If that's you, take a breath. I know it's painful. I know you're probably asking yourself how you didn't see this coming. But here's what you need to ask yourself honestly. Was your thesis based on long-term scarcity fundamentals, or was it based on short-term momentum? Because those require completely different levels of patience. If you bought because you believe in the long-term case for precious metals as monetary assets, then this is noise. Painful noise, but noise. If you bought because the chart was going up and everyone on social media was talking about it, then you need to reassess whether you have the conviction to hold through consolidation. There's no shame in either answer, but you need to know which investor you are. Second, maybe you sold earlier and now you're wondering if this is the opportunity. I get it. Your instinct says bargains appear during chaos, and historically you'd be right. But here's the nuance. Just remember, stabilization usually takes longer than people expect. Silver could chop around this $80 zone for weeks. It could retest the lows. It could build a base slowly while sentiment repairs. Let price prove strength before assuming the bottom is in. Wait for higher lows. Wait for volume to shift. Don't try to catch a falling knife just because it fell a long way. Third, you might be the disciplined observer holding cash, waiting for clarity. Frankly, this is where patience becomes a competitive advantage. You're not emotionally attached. You're not underwater. You can wait for the setup that makes sense instead of forcing a trade because you feel like you're missing out. Markets reward the prepared, not the reactive. Your time will come. And here's the universal principle that applies to everyone watching this, regardless of where you are. When leverage unwinds, price discovery gets messy before it gets clear. That's not a bug. That's a feature of how markets work. Your job is to stay rational while others panic or chase. So here's what I want you to answer in the comments. Which type are you right now? Are you holding and hurting? Are you waiting for confirmation? Or are you sitting in cash looking for the next high probability entry? Be honest. This community learns more when we share real positions and real thinking. Here's where I stand. I'm not treating this as random panic. I'm treating it as a structural repricing tied to policy expectations. That distinction matters because it shapes how I'm watching this unfold. Let me tell you what I'm personally watching. First, I'm watching real yields. If they keep climbing because the market believes the Fed will stay tighter for longer, metals are going to face continued pressure. Real yields are the opportunity cost of holding non-yielding assets. When that cost goes up, capital flows out. Second, I'm watching futures positioning for signs that forced selling is truly exhausted. The Commitment of Traders report will show us whether speculative longs have been flushed or if there's still more pain to come. Third, I'm monitoring geopolitical risk because fear can return faster than people think. If Iran talks break down, if tensions flare elsewhere, that safe haven bid comes roaring back. Based on my analysis, this crash was mechanical, not irrational. It was a liquidation event driven by leverage, margin calls, and a sudden shift in policy expectations. The underlying case for precious metals hasn't vanished overnight. Governments are still running massive deficits. Debt levels are still historically elevated. Currency debasement is still a long-term risk. Those fundamentals didn't change in a week. But if history rhymes, the next phase isn't straight back up. It's likely a choppy rebuilding process that tests conviction on both sides. The bulls will need to prove demand at these levels. The bears will need to prove the policy shift is real and sustained. I'm not a financial advisor. This is not financial advice. Do your own research. Verify everything I've said. Look at the data yourself. Make decisions based on your own risk tolerance and time horizon. If you made it this far, you're the kind of person who thinks independently and doesn't just react to headlines. That mentality will serve you well in markets like these. If this analysis helped you see the bigger picture, share it with someone who needs to hear it. Subscribe if you want more breakdowns like this. And stay ahead of the noise by asking better questions than the crowd. Stay sharp out there. Think critically. Verify the data. And make decisions based on structure, not emotion.